Today's tech news moves fast, but understanding it shouldn't be hard. That's why Snarful Solutions Group brings you Connecting the Dots, where we break down what's happening in tech and why it matters to you. Now, let's dive in with your hosts.
Welcome to Connecting the Dots, the show where we cut through the noise and deliver the essential insights you need to know. I'm Alex.
And I'm Morgan. We're coming to you live from Snarful Solutions Group right here in Sacramento, California.
And it is Friday, November 28th, 2025. We've made it to the end of the week, and we have a few key connections to make for you.
We certainly do.
Before we jump into the markets and the Morning Star, let's quickly touch on the atmosphere. Here in Sacramento, we're looking at some patchy fog rolling in tonight.
Yeah, getting a little chilly, dipping down to a low of 40 degrees.
But nationally, it's a completely different story. Conditions are getting pretty serious.
Oh, yeah. If you're traveling anywhere across the northern U.S. or the interior Northeast, please be careful. We're talking severe winter weather.
Heavy lake effect, snow squalls, gusty winds, just making travel really challenging from the plains all the way to the western Great Lakes. So stay alert out there.
Definitely.
Absolutely. Now let's quickly talk money because it's been a great week.
A very good week.
The Dow Jones closed strong today, pushing up, almost 0.5%?
Yeah, 0.49% to 47,716.42, which locks in a weekly gain of nearly 3%.
Wow. And the S&P 500 followed suit, right?
It did. Closed up 0.39% for the day, and it's showing a really robust weekly gain of 3.2%. Traditional markets are certainly enjoying this momentum.
Totally. And even with Bitcoin.
Yeah.
It had a slight daily dip today.
Just a little one, down about 0.42% to $90,924.
But the key here is, since Monday, it is still up over 3%. So strong bullish signals pretty much across the board heading into the weekend.
It's an excellent start to the holiday shopping season for those portfolios.
And, speaking of shopping, this is a perfect time to mention our fantastic sponsor, Old Glory.
Absolutely.
If you are starting to think about gifts for your techie friend or honestly any fan of music and sports, Old Glory is the iconic one-stop shop for high-quality fan merch and gear.
They've got some really great stuff for the holidays.
They do. And right now they're offering you 15% off your entire purchase. Just use the promo code SNARFL at checkout.
That's at oldglory.com.
All right, let's get right into our analysis with the Morningstar Report. We have 3 stories today, all connecting the dots between finance, cloud competition, and global regulation.
And we're starting on the volatile crypto front. We're looking at a headline that might sound like a retreat, but it's actually a pretty strategic move.
Yeah, that's right. So we saw Europe's largest digital asset ETP manager, CoinShares. This is a company handling about $10 billion in assets.
$10 billion.
They formally withdrew their SEC registration filings, and they pulled 3 specific products.
Yeah.
The XRP ETF, the Solana staking ETF, and the Litecoin ETF.
So when you read that, especially since CoinShares just announced this massive $1.2 billion merger to go public on NASDAQ,
right,
the first thought is, wait, are they backing off? Is institutional interest losing steam after all that excitement?
Exactly. It totally looks like a retreat. But the fascinating part here is that the reasoning is all about regulatory simplification.
So this isn't a retreat at all. It's just streamlining the process.
The SEC actually told altcoin ETF applicants to pull those specific filings, the 19B4s.
Wait, the SEC asked them to withdraw the paperwork. That feels so counterintuitive.
It does, until you realize why. The SEC recently approved new generic listing standards.
Okay.
And these new standards make the old, complicated 19B4 filings redundant for certain products. Now, issuers only need to submit the simpler S1 filings.
So CoinShares is just cleaning house. They're getting rid of unnecessary paperwork to match the new, easier regulatory reality.
It's like, if you're trying to build a new financial product, it's like the government decided you don't need the complex environmental review form anymore, just the basic planning application.
Right. You still want to build the product, you just have an easier path.
Exactly. And the market demand is clearly still there. I mean, we already have spot XRP ETFs accumulating over $800 million in assets in the U.S. alone.
And the Bitwise Solana staking ETF, BSOL, that just launched and is already yielding around 7%.
So this withdrawal is actually a subtle but very positive sign. The regulatory path is getting less cluttered for altcoins.
That's a massive insight that the initial headlines just completely miss.
We've connected the first dot. It's streamlining, not collapse, in the crypto ETF world. Okay, let's pivot now. From financial products to the global cloud wars.
where one legal battle just poof, vanished, and it signals a major strategic shift.
We're talking about Google. They decided this week to withdraw the antitrust complaint they filed back in 2024 against Microsoft's cloud computing practices in the EU.
And not surprisingly, Microsoft's stock ticked up almost 1.32% on the news.
That's a huge legal headache gone for Microsoft, but I don't see this as Google throwing in the towel.
No, not at all.
It seems more like Google is shifting from that expensive, drawn-out process of litigation to prioritizing direct competition and, innovation.
That is the core takeaway for you, the listener. Google is currently playing catch-up. They hold about 13% of the cloud market.
Which is trailing Amazon at 30% and Microsoft at 20%.
Exactly. So they realized that every dollar spent on lawyers arguing about past practices is a dollar not spent on building the next generation of AI-powered cloud services.
It's the classic pivot, right? Stop fighting the court battles and start winning the customer wars.
A very strategic long-term play for Google Cloud, for sure.
They're focusing resources squarely on innovation and enterprise tools to close that 7-point gap against Microsoft.
However, and this is a big however, while Google dropped its specific complaint, it's critical to remember this does not end Microsoft's regulatory trouble in Europe.
Right. And here's where the dot connecting gets crucial. The EU's broader investigation into Microsoft's Azure cloud licensing practices is still very much active.
Absolutely. They're looking into the fundamental structure of their business relationships.
The regulators are intensely scrutinizing what they call entanglement.
They're investigating whether Microsoft uses restrictive contracts, deep bundling discounts, and tight links to legacy products like Windows and Office to unfairly lock customers into the Azure ecosystem.
So if you make it too costly or too complex for a customer to leave Azure for Google or Amazon, that could be a huge competition law violation.
That's the heart of it. They're looking at whether those bundling practices are fundamentally hindering competition.
So even without Google pushing the complaint, the threat of mandated changes or massive fines still hangs over Microsoft's growth in Europe.
And Europe is a market that is increasingly demanding data sovereignty and more competition.
So Google stepped away, but the regulatory storm remains.
Exactly. Google chooses to build better products. Microsoft still has to navigate a really challenging regulatory environment.
Which leads us perfectly into our final story, which takes that whole regulatory environment and just pushes it onto the global stage.
Yeah, this is where it gets really interesting. We're now seeing major tech regulation being treated as a high-stakes bargaining chip in geopolitical trade wars.
We saw some pretty pointed remarks this week from French President Emmanuel Macron. He sharply criticized Brussels, suggesting the European Union is, in his words, afraid of truly tackling U.S. big tech.
And he's attributing the delays in enforcement probes to explicit U.S. pressure.
He was not subtle about it. He framed this as a geopolitical battle, and I'm quoting here, arguing that U.S. platforms simply do not want us to bother them.
I mean, that's about as direct as you can get, and we have concrete evidence of this U.S. playbook.
We do. We saw U.S. Commerce Secretary Howard Lutnick directly urging EU ministers to reconsider the massive new European rulebooks.
We're talking about the Digital Services Act, the DSA, which governs content moderation, and the Digital Markets Act, or DMA, which is designed to stop large gatekeeper platforms from abusing their power.
And the quid pro quo for reconsidering these crucial digital laws: lower U.S. tariffs on European steel and aluminum. That is pure high-level geopolitical leverage.
It's essentially regulatory blackmail, as some EU officials have put it. Teresa Ribera, for example, publicly accused Washington of exactly that.
And this pressure has created a lot of internal friction in the EU, where officials are trying to balance global trade relationships against, the urgent need to enforce their own landmark digital legislation.
So for you, the listener, whether you're running a business that depends on these platforms or you're a consumer who expects better privacy,
the fundamental enforcement of these rules, the DSA and DMA, is being actively influenced by wider trade negotiations involving tariffs on physical goods.
That's the third dot connected. Tech regulation is no longer just about software. It is squarely in the realm of global trade and diplomatic leverage.
The ability of Europe to police big tech is now tied directly to its steel exports.
It's wild when you think about it that way.
Fascinating connections today. Before we do our final recap, let's thank our other fantastic sponsor.
That's right. If you're a golfer or you're shopping for one this holiday season, you have to check out Skoni.
That's spelled S-K-O-N-I and pronounced Skoni.
Yes. They are a premium golf shoe store, offering some truly stylish and high-performance gear.
And just like with Old Glory, if you use the promo code SNARFL at checkout, you can get 15% off your entire purchase.
You can check out their whole collection at scony.com.
So let's quickly summarize the 3 key insights we extracted today.
Okay. First, the CoinShares ETF withdrawal is not a market collapse. It's a necessary streamlining of the regulatory process due to new SEC standards. It's simplifying the road ahead for new crypto products.
Second, the cloud war is shifting from courtrooms to innovation labs. Google is pivoting away from litigation to focus on building better AI services, but Microsoft remains under massive regulatory scrutiny in Europe over their bundling practices. That carries significant risk.
And finally, President Macron's comments highlight that the U.S. is actively leveraging major trade deals like steel and aluminum tariffs to directly influence whether the EU enforces its key tech regulations like the DSA and DMA.
Proving that the digital world is inextricably linked to global economic policy. It's a powerful look at how decisions made far away impact your daily use of technology.
Indeed.
We're here to help at Snarful, so reach out on our website if you have any questions.
That's a wrap on today's top stories. Remember, tech doesn't have to be complicated, and we're here to help connect the dots. If you've got questions or want to learn more, visit us at snarful.com. Thanks for listening, and we'll catch you next time.